Welcome back to the Phuble podcast, a podcast where we talk about all financial markets around the world. I'm Philemon Viennas, and this podcast is sponsored by Phuble, the social networking platform for any and all investors. I am back in the home studio this week, as you can tell. So we're going to get back to our regular routine of just discussing the major markets here in the U.S. It was a big week for all three major indices. The Dow, the Nasdaq, and the S&P all broke record highs. The Dow ended this week, which is the second week in November 2019, up 27,681. The Nasdaq ended the week up 8,475, and the S&P ended the week up 3,093. Gold declined below 1,500 for both the spot index and COMEX. The spot index is currently at 1,459. COMEX is currently at 1,462. I believe this occurred because of the rush into stocks this past week. Flipping to U.S. Treasury bonds, both the 2s and 10s finished the week up. The 2-year yield currently sits at 1.67 and the 10-year yield currently sits at 1.94. The spread is widening for these. There's no inversion between the 2s and 10s, which is good. Same with gold. I believe investors just flowed into the stock market and lowered their position in the bond market. WTI and Brent are still flowing in between that $55 to $65 range that I've talked about before. WTI is currently at $57.24. Brent is currently at $62.51. Once again, nothing really in the market to signal that these prices are going to drastically increase anytime soon or decrease below that $55 range. It's really been holding strong between there, so I think you're just going to see just a bounce back and forth between 55 and 65 for both WTI and Brent. I think the U.S. stock market is going to experience fluctuations going up to the presidential election. Look for gold to pop back up above 1,500. I think that was only a temporary decline down. Bond yields, I think, are also going to be driven down later in the year and early next year, especially if the stock market becomes more volatile. Right now, there is a positive uptrend, of course, with the indices here in the U.S., the major indices here in the U.S. I think it's going to be very volatile, especially with the impeachment inquiries for President Trump. I really don't see these indices staying stable on a positive uptrend. I really think they're going to be bouncing around a lot like they've pretty much been doing this entire year. I thought the Dow was going to probably finish the year around 26,500. Nasdaq would probably finish around like 8,000, and S&P would finish maybe between 29 and 3,000. I still think that's probably what's going to happen, especially like I mentioned with the impeachment inquiry and then also with the uncertainty with U.S.-China trade. There's been a lot of back and forth with that, whether Donald Trump and Xi Jinping will remove some tariffs that were put in place and really alleviate that pressure on global trade. One person says one thing and then another person says another thing, so you don't know. I just think the indices are going to be pretty volatile closing out this year. This week was a big week for earnings. I can't go over all of them because there's a lot of companies. So I'm just going to discuss 4 companies that I thought released significant results. The big one, Disney, had quarter 4 earnings this week. They beat both on the top and bottom line, that is revenue and net profit. Revenue came in at $19.1 billion versus $19.04 billion, which was expected. Earnings per share was $1.07 versus 95 cents, which was expected. These were good numbers for Disney, but keep in mind earnings per share this same quarter, so quarter 4 of 2018, was $1.48 per share. Overall net profit, I believe, was around $3 and $3.5 billion. Breaking down their 4 segments, media network revenue grew 22% year over year to $6.5 billion. The operating income on the media network's revenue was their largest out of their 4 sectors at $1.78 billion. They're having issues again with ESPN driving those costs down, and also with televising the professional sports and the college sports that they display on a weekly basis. Revenue from parks and resorts, which is their main revenue driver, increased to $6.7 billion for quarter 4 of 2019. Net income was $1.38 billion. Studio entertainment rose to $3.3 billion US. Operating income for the studio entertainment division rose to $1.08 billion. That was because of movies like The Lion King, like Aladdin, that had just amazing successes at the box office. Their direct-to-consumer division is the division that's weighing down the rest of the divisions and their overall net income. The revenue for direct-to-consumer was $3.4 billion with a loss of $740 million, almost $1 billion in loss, and that was due most likely to the preparation of the Disney Plus app, which is their streaming service. Switching to Disney Plus, the streaming service is set to release this week on November 12th, 2019 at $6.99 per month. I don't like this. I think the losses from the direct-to-consumer division, which is responsible for the Disney Plus streaming app, will only increase in the future. Listen, Disney has the content, no question about it. They have the content able to do this, able to have their own streaming app, but they're not a tech company. It's going to be difficult for them to really prepare the back end of this application and then also the front end of the application to make it very easy for users to use. Users want a clean interface and they also want functionality. They don't want something that functions well, but they don't know how to use. So you have to have both things in place. It's going to be a learning curve. There's a learning curve for these apps, especially when you do them on a large scale with millions and millions of people using them. Disney has a lot of options. You have Disney Plus, you have Hulu, and you have ESPN Plus. I really think they should have stuck with Netflix. Disney has full control over Hulu. So I think they should have stuck with Netflix for the time being, really figured out Hulu, perfected that platform, and then maybe switch their content from Netflix to Hulu. Not have their own Disney Plus app, because it's confusing. I mean, it's confusing for me to even like figure out what kind of packages I want, what I get, what I don't get. I'm really doubting their ability to really perfect the application, the Disney Plus application. Like I said, they have the content, but it's a matter of perfecting that application. And Netflix has perfected it. Disney tested their Disney Plus streaming application in the Netherlands. Between 8 to 9% of Dutch homes signed up for the service. It was a free service. It was a trial period over the past 2 months, September and October of 2019. Analysts are expecting between 20 to 21 million subscribers by the end of 2020. The big winners of these streaming wars are going to be Google, Amazon, and Roku. All three companies have their own device that pretty much packages all these streaming services into one application, so it's easy for the user to navigate. Google has the Google Chromecast, also YouTube, which is going to be a major winner out of these streaming wars. Just to put into context, Google has, I believe, a little over 1.5 billion registered users on YouTube. Disney Plus is expected to hit between 20 to 21 million registered subscribers by the end of 2020. So YouTube already has an advantage over everyone. The main goal of these streaming services is to gain subscribers from the developing world. Obviously, that's where the majority of the population is located. The thing is, content is just so expensive to produce. It really is. Google has close to zero content costs, because the content is generated by the user. You can find something from anybody throughout the entire world. So the content is constantly being updated daily. They have very, very minimal content costs, and people from the developing world can relate to the content because they see the content that is being produced by people in their countries. And it's free. That's the big one, is it's free. These other streaming services are battling with charging a monthly fee or a yearly fee. If you're given the option to have a free service over a paid service, you're obviously going to go with the free service, especially if good content is being produced on both mediums. Amazon has Amazon Fire Stick, which is like the Chromecast, and Roku has their Roku product, which is exactly like the Fire Stick and the Chromecast, so just packaging all those streaming services. Speaking of Roku, they released earnings this past week, Q3 results. They posted a loss of 22 cents per share versus a loss of 28 cents per share, which was expected. They posted $261 million in revenue versus $257 million in revenue, which was expected. They beat on both the top and bottom line. That's revenue and net profit. There were 32.3 million active accounts this past quarter, up 30.5 million active accounts from the previous quarter. Their average revenue per user is $22.58, which was up from 21.06 cents last quarter. The Roku stock got absolutely destroyed after these earnings results. I think analysts were expecting a bigger beat. They had fantastic results. They're growing as a company. they're doing extremely well. They're really growing their OTT ad business as over-the-top advertising. Not only do they get a fee from the companies that are listed on the Roku app, but then they also sell advertisements as well. Next year, they're going to be up above 150. This would be a great opportunity to buy. They're going to be a huge winner in these streaming wars. Like I said, they package everything together. Moving on, Square, which is one of my favorite companies, released earnings. They've been doing okay this year. 2017 was their big breakout year for the stock. They did okay in 2018. Earnings per share for quarter 3 was 25 cents, which was above estimates of 20 cents per share. Revenue was $602 million versus $596 million. Their gross payment division increased to $28.2 billion. The gross payment is the total amount of payments used on their platform. That was up 25% year over year. Their Cash App, which is huge, this thing is going to be their revenue driver in the future. It's like Venmo. If you don't know what Venmo is, it's like an easier way to send money to other people. It's like Western Union, except it's incredibly easy to send money. They also have Bitcoin on that app. Their Cash App revenue, excluding Bitcoin, was $159 million. That more than doubled year over year. They lowered guidance for the fourth quarter, which is why their stock was kind of fluctuating after hours when they released. They're a really good company. They have great leadership. They began to target small businesses a few years ago, and that's really going to pay off as those businesses grow. Square, by the way, is a payment processing company. They have the chips that you can plug into your phone, your iPad, your Android, or the monitors that allows people to pay for any kind of products. I've been a lot of places, and everywhere I've gone to small businesses, and at least one small business has had a Square product. I hate to leave the podcast off on a bad note, but that's where we're heading with the last company, Yelp. Yelp released quarter 3 earnings of 2019 this past week. Earnings per share were 14 cents per share versus 19 cents per share, which was expected. Revenue was $262.47 million versus $262.25 million, which was expected. The stock was up the remainder of the week due to optimism that they are not going to get crushed by competition, which is Google, essentially. They released decent earnings. They're expecting between 11 and 13% revenue growth in the fourth quarter. I would not touch Yelp. They rely on people to write reviews. Like, that is their main revenue driver, is getting people to write reviews and then also getting people to list their businesses on the platform. They should have just sold to Google, honestly. Like, Google has the ability to just absolutely eliminate Yelp whenever it wants to. You have Google reviews. Yelp reviews don't appear before Google reviews. In order for Yelp to actually make money, people have to go to the website first and then search. Revenue was basically in line. Earnings per share was 5 cents below expected. When investors are thinking, oh, they didn't get hurt that bad on earnings due to competition, so they're probably going to do okay next quarter, that's not a good sign for you to go and invest in a company. Their opportunities are limited, especially since Google runs the search engine world. It's hard. Their whole model, like I said, is based off customer reviews and people using their app. I would not go into Yelp. I just don't see their earnings growing that much in the near future. Okay, that is all for this week's Phuble podcast. Thank you for watching and happy investing.